Good afternoon, ladies and gentlemen, and welcome to this, the 115th annual general meeting of the company. My name is Andrew Ross, and I'm the chairman of the board. It's now 2:30, and I'm pleased to confirm that this meeting is quorate, and we can now proceed to business. I'd like to extend a warm welcome to those shareholders who've taken the opportunity to watch the meeting virtually. This is our second time that we've held a hybrid AGM. I hope this has enabled a number of you who are not able to get here in person to join us today. The format for today will be a presentation from Andrew Bell, our Chief Executive Officer, followed by a question and answer session with him and me or any other relevant members of the board. After that, we will move to the formal business of the annual general meeting. I'd just like to run through a couple of admin points for those in the hall before we start, starting by asking whether everybody can hear me. Enough thumbs up for me to continue. If at any time that is not the case, please raise your hand. Secondly, can I please remind you all to turn off your mobile phones? Thank you. And copies of the notice of this annual general meeting have been circulated, and with your permission, I ask that the notice of the meeting be taken as read. Thank you. I will now hand over to Andrew for his presentation. Hopefully he's not going to fall over the stage on his way to the...
I checked my life insurance on the way in. Well, good afternoon. This is the 4th of May, so as we're all of a generation that probably grew up on the Star Wars films, may the 4th be with you. Well, as the chairman said, welcome to Witan's 115th AGM, I think my 14th. I should like to give today a summary of our results for 2022, the key events of the year, some of which we might want to forget, and some thoughts on the present outlook, accompanied by slides which will appear behind me or for those joining online on your screens. 2022 was a year of two unequal halves, the first of which, from our point of view, lasted 2 months and delivered a political and economic shock to the world when Russia invaded Ukraine. Risk aversion rose, markets fell very sharply, and in those conditions, Witan underperformed. During the remaining 10 months, rising interest rates, inflation at 40-year highs, and fears of recession made for an extremely volatile ride, but by the year end, equities had recovered around 1/3 of their earlier losses, and Witan had outperformed during that period, but not by enough to make up for the losses during the onset of the Russian aggression early in the year. Unlike recent decades, there was no safety in the bond market, owing to the ludicrous trough. We lived with it for so long we forgot how silly it was, but the ludicrous trough to which government bond yields had fallen, near to zero everywhere and negative in Europe and Japan. What used to be viewed as setting the level of risk, the level for risk-free returns, was exposed as offering holders return-free risk in 2022. One surprising example illustrates this. The 2073 long-dated UK index-linked gilt, which carries a government guarantee of inflation protection, fell by 65% in 2022, underperforming Bitcoin, which carries no guarantee of anything. This reminds us that whatever the characteristics of an investment, the price paid determines the future returns. Well, happily, 2022 in the end restored sanity to many asset valuations and thus has presented long-term investors with more menu choices and lower prices than a year earlier. So first, the 2022 results. After a strong run in 2021, 2022 was a weak year for global equity markets. And as the chart shows, or the numbers at the top show, Witan's NAV total return was minus 10.3%, and our share price total return only slightly better at minus 9.8%, but both were behind our benchmark's total return of minus 6.2%. Our dividend rose by 3.6%, a 48th consecutive annual increase. Well, the events of the past 3 years have been exceptional, and the key shocks to the world economy, I think most of us would accept, have been unforecastable. Nonetheless, although our absolute returns over this traumatic period have been positive, it is frustrating to report a third consecutive annual year of underperformance in 2022, with Witan's longer-term outperformance having been undermined by the onset of the pandemic in early 2020 and the onset of war in early 2022. For perspective, despite the lagging performance in 2020 to 2022, over the long term, our 10-year returns were in line with our benchmarks, sustained by outperformance in the earlier years. And this is something we're clearly committed to improving upon, with 2023 year-to-date showing hopeful signs, as we'll come on to later on. During the year, our NAV, this shows the performance, the blue line is Witan's NAV total return, and the green line is the return relative to our benchmark. And our NAV total return, as you can see, hit low points in early March, immediately after the Russian invasion, and late June, which was at the height of the recession fears which were linked to energy prices. Despite an extremely choppy market environment, our managers collectively clawed back about 1/3 of the earlier absolute and relative falls. This slide shows in sort of columnar form the NAV total return contribution in pence per share, taking us from the end 2021 NAV, which was 267 and a bit pence, to 234 pence at the end of 2022. And as you can see, the principal culprit, which was the second column, was the portfolio's capital decline. And other factors, broadly speaking, cancelled themselves out, though with a notable benefit from the value of having fixed our long-term debt at a rate of under 3% before interest rates started to rise. For a third successive year, our stock pickers collectively underperformed, which was perplexing, and understandably much thought was given by both the executive and the board to whether this was circumstantial or structural. Candidly, there's no point being stubborn if something isn't working, but equally, investing with hindsight is no wiser than trying to drive using the rear-view mirror. Well, having carefully reviewed our managers in 2022, approximately a year ago now, we decided to stay with them, and we are glad that we did. The next slide shows the benefits Witan has derived from gearing over the years. The blue bars show the contribution to returns as a percentage of net assets after interest costs. And although gearing can exacerbate losses in down years, such as 2022, and complicate navigation during volatile times, such as 2020, which had some very sharp periods of loss but ended up with a small gain, gearing overall has delivered material benefits for Witan shareholders over the longer term. As you can see visually, that the blue bars above the line are more than the blue bars below the line. The pink line shows our interest costs as a percentage of net assets, and they have reduced from 0.7% a decade ago to 0.4% in 2022, as the interest rate on our fixed-term debt fell from over 7% to under 3% now. Well, this clearly reduces the required hurdle for our portfolio returns to beat the cost of borrowings. And furthermore, having the majority of our borrowings fixed for the next 25 years at a rate of under 3%, we think looks increasingly attractive now that UK interest rates are over 4%. Before coming back to directly investment-related issues, just want to say something about responsible investment, because that has rightly attracted increased attention in recent years. Clearly, investing in well-managed, soundly financed companies with good return prospects isn't a new idea. However, there is an increased emphasis on the sustainability of returns in the light of evolving expectations for corporate behavior, changing regulatory requirements, and the threats and opportunities presented by climate change and the energy transition to a low-carbon economy. And Witan has made a number of significant commitments in this area, listed at the bottom right of the slide and set out in a degree of detail in the annual report. And in particular, we intend that our portfolio will, by 2030, which now only 7 years away, consist entirely of investments in sustainable businesses, by which we mean well-managed, profitable, and financially resilient companies whose activities are seen as adding value for their customers while playing their part in global efforts to use resources more efficiently and to eliminate carbon emissions by 2050. We've developed a proprietary scoring system by which our managers evaluate each of their investments on a consistent basis, providing both a means of measuring our portfolio's progress in the aggregate and identifying particular cases requiring greater monitoring and engagement. Whilst it's encouraging to us that our portfolio currently scores better than our benchmark's average using MSCI data, the key for us is that individual companies, whether in squeaky clean or down-to-earth industrial sectors, have credible plans to sustain or achieve best-in-class performance across the ESG spectrum. The cubist graphic, not something that's perhaps familiar to everybody, it shows there are 7 boxes in total, and they show from dark green being the best to dark red being the worst, the proportion of our portfolio which falls in the 7 bands by which we rank companies. And broadly speaking, the top 3 are seen as performing fine, hopefully improving, no reason for complacency, but they're companies which score, broadly speaking, a 60% or above in terms of quality, and the bottom 2 we view as the problem areas, and we have under 4% in the bottom 2 categories, which require the most remedial engagement. And this evaluation is something that we're going to monitor over time, with the hope, obviously, that we get more towards the green and less towards the red spectrum. But there will be companies which surprise on the upside and those that disappoint. But the joy, and it is a joy, of this scoring system is that it gives us and our managers a way of objectively identifying problem areas and picking them up in a rational debate with management. Now, turning closer to home to dividends, 2022 saw a very significant recovery in our revenue earnings, which had halved in the first year of the pandemic, partly because a number of companies in the stock market passed their dividends, and partly because we were evolving our portfolio to a lower yield benchmark. Witan's dividend per share last year rose by 3.6%, as I mentioned earlier on, to 5.8p, which was the 48th consecutive year of rising dividends, I think every year since I was at university, which is a humbling thought. And this was partly funded using 6.4 million from our retained revenue reserves from previous years, which was down from having to use 14.6 million the previous year. So clearly the call on our revenue reserves is reducing, as our dividend cover last year rose from 65% to 84%. The chart shows also that despite more modest growth in the immediate past 3 years, Witan's dividend per share over the longer term has grown much more rapidly than inflation over that 10-year period, which is shown by the blue line underneath. And we can see the acceleration of inflation, but nonetheless we're succeeding in our long-term aim of delivering real income growth to our shareholders. The board's policy remains to achieve long-term real growth in the dividend as part of a total return, making use of our retained revenue reserves when needed, although we probably have another year or two of slower dividend growth in coming years as our dividend cover rebuilds fully. Turning to the discount, the discount has traded over the last few years in a range of between 5 and 10%, which was wider than in the preceding few years. This has been a pervasive factor across the sector, even among some trusts which had previously consistently traded on substantial premiums to NAV. One of the reasons for, part of it is that over the past 12 or 15 months we've been in a bear market type of environment which tends to subdue investor sentiment. Part of it is that some institutions have, for non-performance related reasons, become less willing than before to hold investment trusts, resulting in a degree of selling pressure at a time when the confidence of personal investors, who make up the majority of Witan's shareholders and many of our competitors, was undermined by economic uncertainty arising from high inflation, rising interest rates, and by the resulting volatile market conditions, which may have improved this year but haven't gone away. Well, our response has been to step up our rate of share buybacks. We bought 58 million shares, which was 7.9% of the total last year, into Treasury at an average discount of 7.8%. Although we'd all like to be, see the company get bigger and bigger, in the end we are individual shareholders where our share in the company is a share in the net asset value. So activities which are accretive to the net asset value, whether they're by investment returns or by share buybacks, are to our benefit. And just for perspective, the resulting NAV uplift from our share buybacks last year was just under £11 million, and that exceeds the total investment management fees that we paid to our external managers, offsetting the majority of our ongoing charges for a second consecutive year. Just by way of sort of stating the bleeding obvious, so to speak, although decisions by individuals about whether to invest in Witan should be based upon a broad assessment of what we do and how it fits with your needs and objectives, mathematically a wider discount presents a better value proposition than a narrow one. And we have been consistently more active than our peers in buying back shares, and it's only 6 or 7 years ago or so that we traded at a premium and were issuing shares. It remains our longer-term objective for our shares again to trade at a sustainable low discount or a premium. And against that background, anybody who buys at a 10% discount potentially gets an extra 10% ride if we get there. The next slide shows how our portfolio last year was allocated between managers. It's a replica of a slide in the annual report, so I don't propose to dwell on it in detail, and certainly don't want to challenge anybody's eyesight in trying to look at the numbers. But just to highlight that we divide our portfolio, broadly speaking, into two chunks, of which 75% or so is allocated to mainstream or core managers, and 5 of them, which represent just under 70% of the portfolio, have a global equity remit, and 1 has a UK-only remit. And that reflects the dominance of global markets in our benchmark. Their task is to deliver returns ahead of their assigned benchmarks. Doesn't always happen, but over time, that's what we employ them to do. The remaining 25%, which is the 4 lines at the bottom of the chart table, is allocated to specialist managers, for example, covering emerging markets and climate change, and up to 15% can be invested in specialist collective funds in areas such as listed private equity, life sciences, property, and commodities, which are typically outside the remit of our mainstream managers. The expectation is for our core managers to select investments from the major indices in our benchmark and to do the heavy lifting, if you like, of delivering investment returns for shareholders, while the other 25% allows Witan to benefit from more specialized areas which have longer-term or more tactical attractions. The next, if you think that was difficult to read, the next slide, again, both the charts are in the annual report, which I'm sure everybody will have read cover to cover very carefully. And it shows the portfolio breakdown between geographical regions at the top and industrial sectors at the bottom. Our exposure is shown in blue and the benchmarks in pink, or whatever that, oxblood, whatever color it is. The portfolio is actively managed, so its makeup differs materially from our benchmarks. For example, geographically, although the US is the biggest country allocation, we have significantly less there than in our benchmark. That had been costly to performance in recent years, but was helpful in 2022, when US technology stocks particularly experienced a significant correction. Although the UK outperformed in 2022, which should have been a bit of a tailwind for us, that return was substantially driven by energy stocks in which our managers were under-invested. The second chart below shows our sector exposure, with a tilt towards more cyclically sensitive industrial areas and away from the major technology giants. That's not forever, it's just where our managers see the value when they look for individual investments. So it should be emphasized that the country and sector weightings are a result of their constructing their portfolios based on the merits of individual companies, not according to some predetermined template. Turning to the future, equity markets in the early part of 2023 have made solid progress, albeit punctuated by concerns over inflation, rising interest rates, and worries that these will plunge economies into recession. To date, global economic growth has held up better than expected this year. Even if it's been very close to zero, that's better than fears of recession. And China's exit from its COVID lockdown policy has provided a further substantial fillip to the world economy. Company profits have also been better than expected, which has helped to sustain gains in the major indices. Witan's portfolio, I'm happy to report, has strongly outperformed, with a rise of, depends a bit from day to day, but this is pretty accurate up to yesterday, with a rise of approximately 7.5%, which is about 3.5% ahead of the 4% or so rise in our benchmark. So our managers this year have collectively outperformed, and clearly after a year or two when they had been not seeing the ball as large as they should have been, while the use of gearing has also amplified the portfolio's gains. And unusually, given their different styles, all 6 of our core equity managers have outperformed by different amounts, but this indicates that perhaps attention to stock-specific detail is beginning to dominate reaction to macroeconomic events, such as we've seen over much of the last couple of years, particularly the shocks in early last year and at the start of the pandemic. The next couple of slides are really just for by way of information for the longer term. This slide shows performance over the last 5 individual years, being quite a lot of variety if you look at the bottom line between strong outperformance and strong underperformance, if that's not an oxymoron, with 2020 and 2022 particularly being impacted by the event-driven weak starts to the year. And the next slide shows that, perhaps encouragingly, despite the weak relative outcomes since early 2020, our longer-term performance remains in line with or just microscopically above the benchmarks over 10 years, with the caveat that neither good nor bad performance should be extrapolated. We're clearly sad to have lost a significant margin of outperformance pertaining 3 or 4 years ago, but we believe and hope that this year is the start of a return to form. Well, finally, and this takes a bit of deciphering, so I'll just talk to it rather than going box by box, with the caution that forecasters fall into 2 categories: those who don't know and those who don't know that they don't know. So this slide summarizes what we see as some of the key influences on economies and markets for the next few years. Economic growth has defied fears of recession, notably in the UK, but elsewhere too, helped by an easing of energy costs and the reopening of China's economy, as we were just dwelling upon, after its lockdowns suppressed activity for most of 2022. A cautionary point is that interest rate rises operate with a lag. So the impact of the rapid rises over the last year or so has yet to be seen fully, and perhaps weakness in the US regional banking sector in recent weeks is a potential canary in the coal mine. Interest rates seem likely to peak soon, we think, but we don't expect them to come down for a while, a Table Mountain rather than a Matterhorn-shaped peak. Energy prices have softened, but we'd caution over avoiding the sector entirely, because there is a structural shortage of energy supplies in the world economy as renewables aren't growing fast enough. They are growing rapidly, but not growing fast enough to both to cope with growth in the demand for energy and to start backing out demand for fossil fuels as yet. On the positive side, fiscal policy over the past year has cushioned much of the energy price blow for consumers, and there are major global capital investment programs planned, multi-year programs and multi-trillions of pounds or dollars or euros planned for the coming 5 or 10 years. And they're linked to renewing obsolescent infrastructure, to building new infrastructure for the low-carbon economy, to expand conventional and sustainable energy supplies, and less joyfully, to increase defense spending. We think there is a lot of spending planned for the world economy, which is not really discretionary, because governments feel, either for the sake of future generations or to cope with an immediate security risk, that they have to address these spending plans and find a way of financing them. So I suspect we're going to see a looser fiscal policy, a degree of tolerance with the pace at which inflation converges towards central banks' targets, which are all around 2%. Once the direction of inflation is clearly coming down, I think the various pressures on central banks and governments will mean that a greater priority will be on trying to grow out of the debt rather than to suppress economies in order for inflation to hit 2% next year. Well, we at Witan retain a long-term perspective and a focus on quality, growth prospects, and the resilience of the companies we invest in. Our outperformance over the past 12 months, or 14 months, has shown the benefits of this approach once investors pay attention to the valuations and merits of individual companies rather than reacting to short-term incoming macroeconomic shocks. We believe that our portfolio is very well positioned for the foregoing longer-term themes, and that our shareholders' patience will be further rewarded in the coming years. So thank you very much. I will now hand back to the chairman, and we'll cover any questions you may have. It's quite important that you spend some time to read the caveats on this disclaimer chart.
Thank you very much, Andrew. And as Andrew says, we are now going to take your questions on his presentation, on the annual report, or indeed any other business of the company. In addition to Andrew and me, we have present the Chairman of the Audit and Risk Committee, Jack Perry, the Chairman of the Remuneration and Nominations Committee, Paul Yates, our Senior Independent Director, Susie Newbert, as well as the other directors, Rachel Beagles, Gabriel Boyle, Ben Rogoff, and the 2 directors appointed since the end of the year, Shauna Bevan and Shefali Yogendra. If you wish to ask a question, please raise your hand and wait for the microphone to be brought to you. Before asking your question, could you please give your name and, if applicable, the name of the shareholder that you represent? If you're watching online, you can ask a question by typing this into the chat function within Zoom. That's one of those sentences that would have made no sense whatsoever 20 years ago, isn't it? And if you see Eleanor and me staring down at the table here, that's because we're trying to read the questions within the chat function. So, ladies and gentlemen, do we have any questions? Yes, please, at the front here. Microphone coming your way.
Hello, Tudor Grassoff. Can you hear me?
Just about.
Hello, Tudor Grassoff. Given the climate emergency, when will you be fully divesting from oil and gas?
Did you hear the question?
Yes, I think the question was just for the benefit of those online. Given the climate emergency and obviously structural changes underway, will we be divesting from oil and gas? I think the short answer to that is no. And there are a couple of reasons for that. The principal one is that if you divest, the chances are the shares will only be bought by somebody who may be less picky and less inclined to try and pressure management to do what they're doing, whether it's clean or dirty, but to try and do it more efficiently and with less damage to the world economy. The fact is, unless we're all going to go back and wear skins and live in caves, we need fossil fuels for a period, but we also need to have a proper plan with political backing and subsidies if need be to phase out fossil fuels and to meet the worldwide targets to reduce carbon emissions to a point which limits the increase in global temperatures to as little as possible. The official target is 1.5 degrees higher than the pre-industrial temperature. I think the principal reason is that if these activities are going to be required, it's important that they are owned by companies, by shareholders who are keeping pressure on management to reinvest in ways of doing what they do more efficiently and to reinvest in sustainables, which a lot of the major oil companies are doing. Most of the time we tend to have relatively low weightings in energy stocks, but that's been in the past for investment grounds rather than particularly, if you like, moral grounds. I think it's fair to say that the bar is higher and the risks are also higher for companies which carry out activities which are carbon intensive, particularly if they are seen as not operating to best practices in their sectors. So, and clearly one of the reasons for our adhering and setting ourselves targets on sustainability is because we don't see there as being a dichotomy between sustainability and investment returns. Companies which aren't, which are seen as not operating in terms of what's good for the future of mankind insofar as politicians define that, and are effectively going to be regulated or competed out of existence. And so if your business isn't sustainable, whether you're an oil company or a pharmaceutical company or a coffee shop, mispaying its employees, for example, in the end you're going to be a rotten investment. We'd like to live in a world where we'd already got to 2050 when if the world can substantially have reduced its dependence on fossil fuels. But the reality is to get there is going to demand sacrifice, is not going to demand investment managers selling shares in those sectors. It's going to demand changes in the way that we all behave. And, and those changes can only happen as rapidly as people are prepared to change or are led by their politicians to change.
Mm-hmm. Thank you. Yes, just behind you here, Graham.
Good afternoon. My name's Phil Clark. I'm a happy shareholder despite the bumps on the road. I've got two questions, if I may, rather different. The first is about your direct investments. The private equity. I've been looking at private equity recently. I'm quite interested. And out of ignoring 3i, but looking at the other PE investment trusts, you've got Princess. And I just wonder why you have them rather than Harbour Vest or Pantheon or NB. Just sort of curious as to why you focused in on that, in fact, rather than just spreading the money around over all of them. I find that very interesting.
Yep.
Secondly, when you've been quoting numbers to us, you've been quoting NAV with debt at fair value, which is, I always find that puzzling because to my mind, debt at par makes so much more sense because that's the truth of it. And I think you should only talk about debt at fair value if you're actually going to do something, because at the moment it's worth 8 pence more or something. So unless you're going to redeem your debt to try and get at that 8 pence, then I'd stick with debt at par. But I'm just curious, and of course you're not going to redeem the debt because it's so good, you want to stick with it. So I'm just curious as to why you use that measure other than the fact it's better at the moment.
Okay, so we've got two questions, again, for the benefit of people listening online. One is with regard to what are choices of private equity funds in the direct portfolio. And the second question relates to why do we use the statistic of debt at fair value rather than at par. I think I've got that right.
On the first, the reason that we hold Princess Private Equity is partly, we've held it for a very long time. We bought it when it was, I think, somewhere around the €5 or €6 mark, and have just ahead of their restoring dividends in 2011. And we've added to and subtracted it as it became more or less expensive, and we were beginning to rebuild our holding in it at the end of last year when the company decided, for reasons that are too dull to go into in detail at the moment, to pass its dividend for the second half of the year. They were caught out because they had a hedging policy that went the wrong way for them, and they ended up in a bit of a cash squeeze. They have actually restored the dividend now, and we're happy that looking forward, they will. They're managed by a group called Partners in Switzerland, who has a long-term good record of management in the sector, and we think they're going to give us good returns from here. It was last year, if you like, was a bump in the road of a 10-year return that had been pretty good. On the other side, and we also hold a private equity fund called Apex. I mean, none of these are recommendations because, but there's a dozen or so stocks in the sector which, for those who are interested, repay a little bit of research to have a look at. But we have actually recently added a holding in the sector, which is Harbour Vest Private Equity. We wish we'd bought all of our holdings when they were at 50% discounts, but the most recent one, Harbour Vest, we have bought, and it was on a 48 or so discount a couple of months ago. It hasn't really moved much since then. So we look for value, but at the same time, particularly the size of holdings that we take, you can't really just trade them around in the way that an individual in your ISA could. On the fair value of debt, well, there's first of all, just to say, we've always tended to quote our performance using the fair value of debt, even when the fair value NAV was lower than the par NAV. At a long period when debt instruments were valued at a premium to par, and the AIC and the various accounting guidance that we have says that we should value both our assets and our liabilities at fair value. Well, assets, clearly, you take the price of your investments in the market. Liabilities is perhaps less transparent, because if you've borrowed 100 million, you're still going to have to repay 100 million. But if you borrowed 100 million at 5% and interest rates fall to 1, the burden of having that 100 million is greater than 100 million of borrowings, because you're having to pay, effectively 5 million of interest, which would fund 500 million of debt otherwise. So there's so when interest rates, so what's happened in the last 12 months is the rate of, and our debt is valued with reference to gilts of a comparable duration, and gilt yields have risen above the level of our debt, and so the present value of the debt is below par. Obviously, we'll have to repay £100 on the nail when it comes due, but the cost in terms of the fair value in the market is below par now, in the same way as if we bought a share and it had gone down in price, we'd have to revalue it downwards. So we're certainly not trying to change the story in response to, because we've always used debt at fair value, and that's the accounting guidance that we get from the AIC.
Thank you. Any more questions? Yes, Graham, just down here, please.
Good afternoon. My name is Stephen Pavey. I'm a long-time private shareholder of Witan, and my question concerns the churn rate that you have within the portfolio. I did some little calculations on the train coming up here, and I think, according to your cash flow statements, you purchased something like 800 million of shares during the year and sold 925 million or so, which is approaching a churn rate of about 50%, which, again, my calculation would suggest that the average shareholding of individual shares is about 2 years. Now, does the board think that's appropriate to have that level of churn rate, given the fact that your report says you've got a high conviction portfolio, which my sort of simple sense would mean that you'll buy shares and you want to hang on to them? Mm-hmm. So that's my first question. My subsequent, which is a supplementary to what I've just said, is what instructions do you give to your individual managers about their own churn rates? Do you set targets for them? Do you monitor them? And would you also be concerned if they had an excessive churn rate, given your pretty relative underperformance for the last 5 years? Thank you.
Some of the, if I missed your question, it was slightly muffled because of the quality of the microphone. But the question essentially seems to have been, the accounts seem to show a relatively high rate of turnover of the portfolio, implying that we're only holding shares for an average of 2 years, and how does that square with a long-term approach? And do we look at our individual managers' turnover levels and work out whether they are consistent with what we're asking them to do? I think is broadly the gist. I think the first thing to say is that the turnover rates vary hugely between our managers. For example, Lindsell Train make a blessing of virtually never selling a share. I mean, their turnover rate is, they're disappointed if it's as high as 2%. And there are others which, where the turnover rate, either they try and trade anomalies within the market. They might hold a bank, or they might have a building stock, and one goes up more and they switch it into another. That's perhaps less of a fundamental driver of returns than being in the right sectors, but some of them are quite good at it. And sometimes the markets become more disorderly, which give you an opportunity to sell a holding that you might think is better quality, but it's held up better than another one. So turnover between managers varies a lot. Turnover by individual managers also varies a lot. I think our instinct is we do tend to question quite closely the managers that have quite high turnover rates, particularly if the performance has gone through a glitch, because what we want them to question is whether the turnover is just like fun to do, or whether it's adding value. Would you be better spending the time finding better investments? I think in the end, we don't tend to be prescriptive in trying to tell people how to manage money on our behalf. If we're dissatisfied with the results, or if we've lost confidence with them in the future, then we will move on. But trying to tell people that you'd rather they didn't turn over so much, or we'd rather they didn't hold oil stocks, or got out of banks, is essentially, if you're choosing people on the basis of what you hope are good at, there's not much point in trying to overcall what they do. Instinctively, I think we all think, well, turnover is a cost on investment markets, and Warren Buffett famously said, your investment broker will fill your ear with wisdom but won't fill your pocket. And so, if we could find 8 managers who could just buy and hold a portfolio and turn it over minimally, we'd be very content with that. In the same way as we individually would love to buy investments and then go away and just spend the dividends. It's rather an inconclusive answer, because we're attentive to whether high turnover rates are value additive for our portfolios. The other point to make is that actually the cost of turnover, though with the collapsing commission rates in recent years, has become a lot lower, and that doesn't make us want to see more turnover, but it may be that it's become less of a drag, and so 1 or 2 managers can quite churn their portfolios. We would rather they concentrated on finding good companies. And in the end, the proof is going to be in the eating, because although the last 2 or 3 years have been very up and down, particularly over a couple of very short periods for Witan, the longer term is that our managers have tended to add value since we appointed them. And that's really down to all factors, but I think the biggest factor is going to be stock selection. I don't remember us sacking anybody for excessive turnover, but if they had high turnover or low turnover and the performance was confidence sapping, then we'd get rid of them.
Thank you. Okay, I've got a question online. The spread of investments appears to show relatively low exposure to Asia. Why is that, considering better returns might be expected from that geographic area?
It does tend to vary. I mean, most of our global managers over the last year or two have had very low allocations to Asia. That's partly because Japan has been a bit of an investment vacuum for many global managers for a long time, even now that the economy started behaving better. And it's partly because the Chinese lockdowns had a pervasive negative effect on a lot of Southeast Asian economies last year. So we're aware that although they could hold Asian stocks, they have relatively low weightings in stocks which are domiciled in Asia. Some of them have quite substantial exposure to companies with exposure to Asia. I mean, Unilever is an example where it's held by 1 or 2 of our managers, where you have LVMH and Gucci and so forth. Similarly, have a lot of Chinese sales, a lot of Indian sales. So what you see in terms of country domicile is not necessarily where the sales exposure is. We also have an emerging markets manager whose weighting to Asia tends to vary quite considerably according to vicissitudes of what's happening in China or other countries in the region. And if you take emerging markets and Asia together, we're actually slightly overweight relative to our benchmark. It's a small weighting in the world economy, but there's no reason. I mean, that could change if one or other of our global managers found that they wanted to buy manufacturers in Southeast Asia or consumer goods companies in Japan. Then they would do so. But for most of the last year and a half, it's been an advantage not to be excessively exposed to Asia on the basis that what people have often found is it's a growth honeypot, but the growth often accrues to companies who sell to the region rather than those who produce in the region. But nothing against Asia, just that's where we are at the moment. Sorry, to the computer.
There's a question in the corner there.
Yes, good afternoon. Henry Langley. If we could possibly have a look at the slide on investment managers' performance, because I've got a question on that.
That should be it, yes?
Yes. I noticed on that you said you were quite happy with what the managers were doing and you hadn't made any changes. I did notice on the figures that 2 of them, and the core managers, did seem to be underperforming quite considerably, notably Jennison and to a lesser extent WCM. I've read the reason for that in the annual report. I think 2 related questions. Are you satisfied with that degree of underperformance, and have they both those been outperforming since things have improved in 2023?
So the question relates to the performance of WCM and Jennison, who are the 2 newest managers into the portfolio, who've both underperformed since they've been brought into the portfolio. Are we happy with that? No, but I'll let Andrew go for longer than that. And have they shown any recovery this year? Yes.
Yes.
I'll let Andrew
I think the underlying reason is when we changed our benchmark at the beginning of 2020, which was unlucky timing because we were trying to make a transformation towards a more growthy and a higher US weighted benchmark in the teeth of the onset of the pandemic, when basically the US and technology stocks went off on a tear. So we were a bit left behind, which was why we had such a torrid first quarter of 2020. But we recognized that although we had managers who would have an open mind as to what they wanted to buy, we didn't really have any managers whose instinct would be to look for the long-term growth stocks of the future. So we did a search over the summer of that year and appointed WCM and Jennison as managers in August that year. We recognized that after tech stocks and growth stocks had such a burning performance over the previous year or two, it wasn't great timing to do that, but we felt we needed to have somebody who would do that for us. So we allocated, I think at the time we allocated 8% to WCM and 4% to Jennison. So they were, even between the two of them, they were the lowest weighting that we had allocated to any global manager. And we gradually, through part of 2022, 2021 and 2022, we added to them very gradually. But even at the end of last year, I think they amounted to something like 5% in the case of Jennison and 10%, it might have been 6 and 11 or something like that. So that even then, they still amounted to approximately one global manager between them. And thank heaven we had so little allocated to Jennison, because although we recognized that we wanted a better buying opportunity for ultra growth stocks, we and they, I don't think, expected quite such a sharp reversal as you saw in some of the growth stocks during 2022. Cutting to the chase, this year Jennison is by a country mile our strongest performer. They're up by something, I think they're outperforming by something in the low to mid-teens, and WCM are outperforming but by a smaller number. So I think the key thing over a year like last year is, do you think, have we made a mistake? Have they lost the plot? Or is this just something where we've been holding the wrong sort of stock in an environment where there was a huge derating for growth stocks? And we concluded, and this was a year ago or so, that we should stick with them, and we believe in the longer term. I mean, both of them have been outstanding performers over 10 or 15 years, and although we're averaging below par over 2 or 3 years, we hope that on average the next 6 or 8 years are going to pull us back above. So we're very happy with them, but never satisfied with underperformance. But when you have whether you've got good or bad performance, you can't do anything about it. What you have to decide is, do you take profits, or do you get rid of them, or do you add, or whatever. So it's how you think about the future. Happily, we haven't had to be unduly patient with Jennison, because they've made up a lot of the underperforming ground during just the first 3-4 months of this year.
Dan, here at the front, please. The microphone's coming the other direction.
I'm Christopher Arnander. I just want to ask how long it takes for you to ditch a manager which is failing. Obviously, some of the managers which have a big lapse in performance, they might in fact be sitting on tremendous good conviction stocks. Do you give them 3 years or 5 years or 7 years? What's the sort of contract that you have with them?
Okay, so the question relates to, well, partly to the nature of the contract that we have with the managers, but more to do with how, I think you're asking how patient we would be with underperforming managers. Yes? Yeah.
The contract question is very straightforward. All of our managers, bar one, are on notice periods of a month. One of them, I think, has 3 months.
A month.
1 month, and one has 3 months. So the costs of change, if we feel that we've made a mistake or lost faith with them, or the key person's left or whatever, are very small. And in fact, the notice period, generally speaking, is less than it would take to go through a process of searching for a new manager. So from that point of view, the frictional costs are to our advantage. Clearly, if we acted in a way that we kept hiring and firing people at a month's notice, we either wouldn't get managers that we wanted to get, or they would want higher fees to account for the job insecurity. In terms of patience, it really depends. The key thing is, do you still believe in the manager's ability to deliver good performance in the future, and is the opportunity for which you've allocated money to them one that you still want to allocate money to in the future. For example, you might have a Europe-only manager, but you might have decided in the future you don't want to have a Europe-only manager, so even if they're a good manager, you move on. Or and your decision whether you've lost faith in them in the future is coloured by whether they've performed well or not in the past, but it's not determined by that, because just as an example, there was a deep value manager we had from the inception of the multi-manager model in 2004 until approximately 2015 or so. And they had some very bumpy rides, including during the financial crisis, and the board at the time, before I joined the board, recognized that there were reasons why they'd underperformed, could be rationalized, and they had a storming recovery from the financial crisis. And then they, in about 2011 or 12, started making one or two, they had a period again when performance was drifting, and they made one or two investments that for a manager that's trying to pick stocks, at 70% of their intrinsic value, why were they allocating 5% to a Brazilian exploration and production stock? And their rationalization was that potentially the assets were worth 17 billion and the value of the company was only 500 million. But that rather ignored the fact that they were investing in a speculative stock where the oil might not be there and the politicians might not let them produce it. And that went together with a couple of investments they made in Europe where their checking out network in European companies was less good than their checking out network with companies in their home base in the US. So two things struck us. One, they appeared to have less confidence in their own process, and two, they appeared to be trying to go for a Mars or bust thing to turn performance around. So, and they hit a nadir where we had a really poor meeting with them, but we decided not to get rid of them because we felt that all the bad news was in the price. And then 18 months later, they were very shocked when we did get rid of them, when they'd outperformed by a decent amount. But the key point was that we'd lost confidence in their process and their potential to outperform in the future. We were just waiting for a better selling opportunity. So the answer is it depends. The danger is you get sort of lulled into giving people another chance. And if that happens with all of your managers, then you end up with really, entrenched bad performance. You hope that that the number of people going through a dull period is like 1 or 2 out of 10, and that you can be patient. But the key to whether you are patient or not is whether you believe in them. Sounds a bit religious, but that's it.
I think the other thing I'd say is that our instinct is to stick with managers and be patient with them, rather like the point made over here about individual stocks and shares. If you start trying to double guess managers' peaks and troughs, you're going to end up chasing your tail. So our instinct is to stick with managers. Mm-hmm. Right, I think we've had a good wide range of questions. Thank you very much. And I should now like to move on to the formal business of the meeting. I'd be clearly happy to speak to anybody present who's in the room after the meeting, and if there were any other questions from online that haven't been answered, and I'm pretty confident that's not the case, we have none, but do send an email to contact@witan.co.uk and we'll respond. So before we move to the resolutions, are there any further questions, in particular any questions on the subject matter of the resolutions? Thank you. So in accordance with the company's Articles of Association, we expect to decide each resolution on a show of hands. At the appropriate point, please raise the voting card that the registrar gave you when you arrived in the hall. As advised in the notice of the meeting, those of you watching online will not be able to vote at the meeting, but if you lodged your proxy votes in advance, these will be included in the results. The proxy votes lodged in respect to the resolutions will be displayed on the screen for your information, and copies of the schedule of the proxy votes are available on request from the Secretary and will be put up on the Witan website. So I propose the first resolution that the annual report and audited financial statements for the year ended 31st December 2022 be received. I put this resolution to the meeting. All those in favour? All those against? Can you just wait for a microphone? Well, unless you think you can shout loudly.
I can shout.
Okay.
I was given a poll card to fill in, which I filled in and I handed to the registrar. And I look around me in the audience here and I see lots of people with the poll cards. So I just wondered why you're voting with a show of hands when we were given a poll card to fill in.
The reason for giving you a poll card was in case we needed to run a poll for any of the particular questions. The poll card doubles as your voting card, and I'm sorry if that wasn't clear to you. If you put up your hand, I will make a note of your vote.
Can I just say this is the first annual general meeting I've been to where that process has actually been enforced. You either tell everybody it's a show of hands or you hand them a poll card and fill it out and collect it.
I understand exactly what you're saying, and I'm sorry for any confusion.
I think the other point is that if somebody was here as a guest but not a shareholder, then they wouldn't have a card and wouldn't be eligible to vote. And so it's, although we know that you're a shareholder and were eligible to vote, despite your yellow card being somewhere outside, there's no discourtesy intended.
Thank you.
Thank you.
And I declare the resolution duly carried. I propose the second resolution that the Directors' remuneration report for the year ended 31st of December 2022, other than the part containing the Directors' remuneration policy, be received and approved. I put the resolution to the meeting. All those in favour? All those against? I declare the resolution duly carried. We will now deal with the resolutions electing or re-electing all the directors. I prefer the third resolution that Miss S.L. Bevan be elected as a director of the company. I put that resolution to the meeting. All those in favour? All those against? I declare the resolution carried. I propose the fourth resolution that Dr. S.M. Yogendra be elected as a director of the company. I put the resolution to the meeting. All those in favour? All those against? I declare the resolution duly carried.
I propose the fifth resolution that Mr. A.J. Ross be re-elected as a director of the company. I put the resolution to the meeting. All those in favour? All those against? I declare the resolution duly carried.
Thanks, Susie. I propose the sixth resolution that Mrs. R.A. Beagles be re-elected as a director of the company. I put... Nervous moment for Rachel there. I put the resolution to the meeting. All those in favour? All those against? I declare the resolution duly carried. I propose the seventh resolution that Mr. A.L.C. Bell be re-elected as a director of the company. I put the resolution to the meeting. All those in favour? All those against? I declare the resolution duly carried. I propose the eighth resolution that Mrs. G.M. Boyle be re-elected as a director of the company. I put the resolution to the meeting. All those in favour? All those against? I declare the resolution duly carried. I propose the ninth resolution that Mr. J.S. Perry be re-elected as a director of the company. I put the resolution to the meeting. All those in favour? All those against? I declare the resolution duly carried. I propose the 10th resolution that Mr. B.C. Rogoff be re-elected as a director of the company. I put the resolution to the meeting. All those in favour? All those against? I declare the resolution duly carried. Now, for those of you with eagle eyes, you will have noticed that one director is not proposed for re-election, and that is Susie, who will be standing down from the board after this meeting. And she's been a wonderful long-term servant of Witan. Her experience and contributions at the board table have been absolutely invaluable, and in the last couple of years she's been a very good senior independent director for the company. So Susie, on behalf of the shareholders, I'd like to thank you for your contribution.
Thank you very much, Chairman.
I missed one. I propose the 11th resolution, sorry Paul, that Mr. P.T. Yates be re-elected as a director of the company. I put that resolution to the meeting. All those in favour? All those against? I declare the resolution duly carried. I propose the 12th resolution that Grant Thornton UK LLP be reappointed as auditor of the company. I put the resolution to the meeting. All those in favour? All those against? I declare the resolution duly carried. I propose the 13th resolution that the Audit and Risk Committee be authorised to determine the remuneration of the auditor. I put that resolution to the meeting. All those in favour? All those against? I declare the resolution duly carried. Thank you. That concludes the ordinary business of the meeting. We now proceed to the 6 items of special business. So the 14th resolution is a proposal to approve the company's dividend policy. Dividends on the ordinary shares are payable quarterly in March, June, September and December. The company's policy is to seek to grow its dividend ahead of inflation, funded by portfolio income, retained revenue reserves, and, if necessary, as part of a defined path towards dividends being once again fully funded by revenue earnings, realised capital reserves. So I propose the 14th resolution to approve the company's dividend policy. I put that resolution to the meeting. All those in favour? All those against? I declare the resolution duly carried. The 15th resolution is a proposal to authorise the directors to allot securities in the company up to a maximum of 10% of the existing share capital, subject to the provisions set out in the resolution. I propose the 15th resolution to authorise directors to allot ordinary shares. I put that resolution to the meeting. All those in favour? Thank you. All those against? I declare the resolution duly carried. The 16th resolution is a proposal to disapply the rights of preemption in relation to the allotment of equity securities or sale of shares in Treasury, subject to the provisions set out in the resolution. This means that these shares do not have to be allotted or sold to existing shareholders. I propose the 16th resolution as a special resolution that the directors be authorised to allot equity securities for cash and to sell shares held by the company as treasury shares on a non-preemptive basis. I put the resolution to the meeting. All those in favour? All those against? I declare the resolution duly carried. The 17th resolution to seek authority to buy back the company's ordinary shares is set out in full in the notice of the meeting. Since the year end, we have bought back 19,193,891 shares, including 7,334,035 since the notice of the meeting was published in March. Therefore, the resolution is for authority to buy up to 99,028,329 ordinary shares of 5 pence, being 14.99% of the ordinary shares in issue today. I propose the 17th resolution as a special resolution that the company be authorised to make market purchases of its own ordinary shares. I put that resolution to the meeting. All those in favour? All those against? Noted. I declare the resolution duly carried. The 18th resolution to seek authority to buy back the company's preference shares is set out in full in the notice of the meeting. No preference shares have been bought back under the authority given a year ago. Therefore, the numbers set out in the resolution have not changed since the notice of the meeting was published in March. I propose the 18th resolution as a special resolution that the company be authorised to make market purchases of its own preference shares. I put that resolution to the meeting. All those in favour? All those against? I declare this resolution duly carried. The 19th and final resolution is a resolution to permit the company to call a general meeting other than an annual general meeting on no less than 14 days clear notice rather than the normal 21 days. In the event that a general meeting is called on less than 21 days' notice, the company must make a means of electronic voting available to all shareholders for that meeting. I propose the 19th resolution as a special resolution that any general meeting of the company other than the annual general meeting may be called on not less than 14 days clear notice. I put the resolution to the meeting. All those in favour? All those against? Noted. I declare the resolution duly carried. That now concludes the formal business of the meeting, and I declare the meeting closed. If you've watched the meeting online, it would be very helpful if you could let us have any feedback on your experience today, either through the chat function on Zoom or by emailing contact@witan.co.uk. Thank you all, both online and here in the hall, for your attendance, and I hope those of you that are here in person will be able to stay and join us for a cup of tea, which will be served in the cloisters. Many thanks.